Okay, good morning, everybody. I can't see on my screen how many have joined so far, but it's 8 o'clock. We've got a packed session, so keen to start. So my name is Bill Baker. I'm the chairman of the Suffolk Agricultural Association, and it's my honour to welcome you all here this morning to the virtual farm briefing in conjunction with Fram Farmers, HSBC, Scrutton Bland, and the Agricultural Association. So we've got a packed lineup. It will be rapid fire. I would urge you all, please, to introduce any questions that you may have through the Q&A button at the bottom of the screen, and we will collate all the questions to the end of the session. So it gives me great pleasure to welcome one of probably the most or one of the most clued up in the current affairs of IHT, and that is Nick Banks from Scrutton Bland. He will guide us through it, but there's a big topic, and as he said himself, there's a lot to cover in a short space of time. I don't think in my career I've ever known a time when we, as an agricultural industry, have needed to lean on our experts and advisors so heavily. April 26 will come round very, very quickly, and I'm sure the advisors that we rely on will be very busy in that lead up. So I urge my fellow farmers on the calls to not delay in contacting your advisors, because we certainly need them. So Nick, if I could hand over to you. Nick is a senior partner at Scrutton Bland. He leads the agricultural team and is well versed to guide us through the topic. Thank you, Nick.
Thank you, Bill. Morning, everybody. Lovely sunny morning. As Bill says, I'm a partner and lead our agriculture team at Scrutton Bland. And yes, it's going to be quite a 15 minutes or so. There's a lot to cover, so forgive me if I run at quite a pace. But I do encourage questions to be submitted. I think the first thing I would say is that it's a very unusual and unsatisfactory situation to be in as a professional advisor, whereby you're having to advise on significant decisions for the family farm against a backdrop of uncertain legislation and lack of clarity. And I'll come on to what could happen later in my presentation, but it's certainly an unusual situation to be in. And inevitably, it's causing a lot of anxiety amongst our clients. I can't help but present this without reflecting on a conversation I had with one of my clients the week before the budget. I think Graham is on the call. If he is, good morning, Graham. And Graham and I spoke to discuss anything that should be done pre-budget. And I remember saying to Graham, well, you know, I'd be surprised if any government of any colour would introduce a tax that would undermine and compromise a viable family business, whether it's a farm or a widget manufacturer. But sadly, that appears to be where we are. So what were the key budget announcements for farmers? I'm hoping this is going to work, because in the practice, here we go, excellent. So what were the key budget announcements for farmers? A lot of this has been well documented, so I'm not going to dwell on it in detail, but just skim through. Clearly, we have the massive implication of what's now been labelled the family farm tax, which is the changes to APR and BPR effective, as Bill said, from the 6th of April. I'll break that down in a moment. We did have a useful extension and clarity of the fact that APR can include environmental land management schemes, as we're increasingly encouraged to plant more flowers and create habitat. So that's a very welcome clarity. Capital gains tax. The rate of business asset disposal, which was previously known as sort of rebranded entrepreneurs relief, the 10%, which is an attractive rate of tax where the conditions can be met for claiming, that rate is increasing to 14% from the 6th of April and 18% from the 6th of April 2026. And there are anti-forestalling measures that have been introduced, obviously where you're trying to secure an advantage in the timing of exchanging a contract to complete to secure the most advantageous rate. And there was also an immediate increase to the main rate of capital gains tax from 20% to 24%. That was effective from budget day. The next bombshell in the announcements was the fact that pensions are intended to be called in the IHT net from the 6th of April 2027. There is a full consultation to be made before that legislation is formed. Obviously, that consultation is welcome. Regrettable that not such a similar consultation undertaken in terms of the IHT announcement. And it's difficult to see how the mechanics of how these tax charges on pensions will be assessed. For example, whether it will be taxed and the tax has to be paid by the fund. A number of owner-managed farmer pension funds are in the form of a SIP, and often they include buildings that are occupied and let by the farm business. So those SIPs are potentially quite illiquid. So, if there's a tax charge levied on that SIP, how would that be funded if there's an absence of liquid funds in the SIP to pay that tax? All of this we expect to unfold over the coming months, and clearly we'll update as best we can on our social media channels as we learn more. Something that was sort of in, out, was the double cab pickup treatment. That's now being confirmed that double cab pickups won't be treated as plant and machinery from the 6th of April 2025. So there's an increasing shrinking window to try and secure such a vehicle, if that's your preference, to make sure that you've got the optimum capital allowance relief. And obviously, going forward, we need to be alive to changes in capital allowances and indeed benefits on kind if you have employees in your farm business that have a double cab pickup. The next announcement, which is clearly relevant to farm businesses, is national minimum wage increases, particularly if you've diversified into hospitality and you've got a number of lower paid workers. That's a material increase to your wage bill again in the hospitality business where often it's quite tight margins. And on top of that, there's the employer national insurance increase to 15.8%, but also the reduction in the lower earnings limit. So a significant increase in NI, albeit the employer allowance is potentially more lucrative where the circumstances to claim it are met. In addition, there was the acceleration of the BPS reduction assurances that the pot of funding available is protected, but clearly that acceleration, where the maximum that can be received is 7,200, is going to have a material impact on some. And obviously, brings into sharper focus the need to focus on maximising SFI, and obviously Will follows me and is an expert in that. Something that wasn't in Rachel Reeves's budget, but was announced in the Jeremy Hunt budget of the previous government, which we mustn't lose sight of, is the fact that the furnished holiday letting regime is being abolished. And after the 5th of April 2025, holiday lets lose their business asset status, particularly for CGT. That the IHT relief around holiday lets has been whittled away to the point where it's a very high bar to qualify. But certainly that's very relevant to any holiday let assets that might be in portfolio of assets to look at in the context of planning to manage succession. From my perspective, I'm in a privileged position where I advise a good number of farm and family businesses, and some of those relationships have endured a number of years. I also have a wonderful network of professional colleagues that we discuss and compare notes. And I would sort of summarize that the sentiment at the moment is that the budget really is, I guess I should caveat this, it's probably a personal view before my marketing team start to sweat and not necessarily the view of the firm. But the sentiment, in my view, is one that sort of it's sucking aspiration, it's bashing entrepreneurship, and it very much feels a constraint on business, which is counterintuitive to the need to grow the economy. So the approach, arguably is misguided. The focus is not quite where it needs to be. I think we accept tax receipts need to increase, but I lament the fact that there wasn't a wider consultation to the champions of this industry and also the relevant professional bodies that advise this industry. But we are where we are. So my next slide unpacks the APR and BPR changes. Again, very well documented, headline of £1 million exemption, 50% thereafter, which is an effective rate of 20% on APR and BPR qualifying assets. On the 27th of February, so last week, 27th of February, there was the technical consultation, which was announced in the budget regarding the impact on trusts, was released. That's an interesting read if you're inclined to read it, and it does provide some useful clarity. So from it confirms actually that the £1 million allowance will behave like the nil rate band, so it'll be refreshed every 7 years for an individual. That's useful. There's no reference to that £1 million being CPI linked or RPI linked, but that matches the nil rate band, and of course that's the policy of fiscal drag that's often mentioned around budget time, whereby holding allowances at a time of inflation means that ultimately the tax take will increase. So with that £1 million refreshing and the rules of the 50% allowance, then potentially in the context of a trust, 1.65 million of qualifying property could be settled, because that would be the £1 million exemption, and then 50% applying to the £650,000 would leave £325,000 that's matched by the nil rate band of the set law. The trusts themselves, a relevant property trust, I'm mindful that we've got a mixed audience, so I'm not going to go too technical, but a number of farmers on this call may have a trust within their business structure, and they'll be familiar with advisors talking around sort of periodic charges of entry charges, 10-year charges, exit charges, and the £1 million exemption applicable to a trust is refreshed on that 10-year cycle. So that's relevant to the calculation of periodic charges, and it's clear from the consultation document that an already complex calculation will only get more complex. That's our problem, not yours. Assets settled into a trust before the 30th of October 24, the new rules, the consultation document sort of states that the new rules will not apply to distributions of 100% qualifying assets until after the first 10-year anniversary after the 5th of April 2026. Dates are important here, but that does mean for certain circumstances there's a potentially advantageous planning window where it can be claimed. The document confirms that I think it was expected that this £1 million transfer, this £1 million exemption, as my slide states, is not transferable like the nil rate band, and that's a really important point. That the £1 million is utilised on the death of the property owner, because it can't, for example, be transferred to the surviving spouse in the same way that the nil rate band can. So that's a very relevant point, which I'll come on to in one of my examples in a moment. The consultation also covers off something called anti-fragmentation. So, this policy is going to drive the businesses being split across multiple ownership as farmers start to gift. So that's going to fragment, it could have the risk of creating quite complex structures, but also where ownership is fragmented, there is opportunity to discount value. And that HMRC are alive to. So if you were minded to try and settle parts of an asset across multiple trusts, then effectively there wouldn't be a discount in value, and the £1 million would be shared across those trusts. So that will be interesting how that plays out. Certainly one for the valuers to look at in the fullness of time. That covers off, I think, the most recent announcement in terms of some of the headlines from the technical consultation. What I'd like to do now is just explore some sort of real examples that are on my desk, which we're working on, because I think this sort of shows the impact of the APR family farm tax issue. I think the first thing I would say is important not to panic. It's important to take time to make the best decision. Clearly, age is a factor. And I have a number of clients where we've had useful conversations, but the outcome might be, well, let's sit tight, check your life insurance for a sort of an Armageddon event to safeguard against an inheritance tax bill that you didn't have before October. But let's make sure that we're making the right decision, because these are big decisions, and in some instances it may not be appropriate, or the owner of the asset is not comfortable gifting the asset to the next generation for different reasons. Often matrimonial fear of matrimonial challenges is raised. Often it may be minor children, which is then a problem in the context of gifting. So what my table shows here is 4 examples: Farm A, B, C, and D. I've shown there what the inheritance tax liability attached to those farm businesses is. In the next column, I've calculated what the average 2-year EBITDA of those farm enterprises is. So what I've done is I've taken the profit from each farm, I've adjusted it for drawings and tax, because that's effectively a wage cost to the proprietor of that farm, to say, well, this crudely is a measure of how much cash these businesses can generate. And often this calculation is done in the context of how much debt can these businesses sustain when talking to a bank or making a decision on financing a machine. So Farm A, B, C, you can see that they've got varying levels of inheritance tax, varying levels of EBITDA performance, varying levels of debt. But in terms of the cover, where I've highlighted it green, as things stand without an IHT liability, those businesses are quite sustainable. I would add that my figures are based on accounts up to March 2024 and the previous year. So I'm capturing results from the 23 harvest and the 22 harvest and the 23 harvest. Obviously, the 22 harvest for many post-Ukraine was a bountiful harvest. So arguably that EBITDA is inflated over what it might be if I was to look at the 23 harvest and the 24 harvest. Farm D is not showing a cover figure. I'll explain why in a moment, because that's a structure whereby we have the land being let to a company, and it's the company as the trade, so it's the rent that the owner of the land receives in the context of that structure. What I can then show into the right of that table is the fact that if these farms don't take action and they do pay their inheritance tax bill over 10 years, how sustainable is this farm in affording not only its existing debt, because you have to replace machines. Some of these farm businesses have legacy bank debt from purchasing land previously or restructures previously. How sustainable can these farms manage this inheritance tax burden? And you can see that Farm A and Farm B I put as amber, 1.1, 1.26. If this was a decision with a bank as to whether or not this farm could borrow that money, it's likely the answer would be no. Obviously, Farm C, with a much more significant inheritance tax liability, it's clearly not sustainable that its ordinary operating performance can sustain that level of debt in repaying machine finance, loans for land purchase, and also its inheritance tax liability. Even if Farm A and Farm B were to pay this inheritance tax, it would starve that business of its ability to invest in diversification to try and make itself more sustainable. And bear in mind my comment that these results include harvest year 22. And I can confirm that if I ran these figures for Farm A and Farm B on harvest year 23 only, then that cover would be sub 1 in both Farm A and Farm B. So clearly, none of those businesses can sustain this inheritance tax burden. So breaking some of these examples down, and I may not have time to go through all 4 because I'm just mindful of time. I keep checking my clock, but I'm sure Bill or Rachel will warn me when I'm running out of time. So Farm A, this is a family who are very anxious about the outcome and are taking positive action to try and address their inheritance tax liability, which is just over £400,000. It's an atypical family farm. Father is 77. So again, this is a sharp focus of age and the need to survive 7 years, because all of these examples are in the backdrop of these gifts are subject to 7 years, as you know, has been well documented. So the partnership comprises father, his son, and daughter-in-law. It's a combinable crop with a small big enterprise over about 370 acres. No bank debt, hire purchase for tractor. So how do we mitigate and try and hedge against this inheritance tax liability falling due? So immediately there's a desire to gift land to the son. Capital gains tax holdover relief can be claimed. That does mean that obviously if that land is sold at some point in the future, that gain will be crystallized. But clearly the intention is, you know, the family farm wants to stay in the family, so that should not be an outcome that's anticipated. The challenge with this particular one is that the wife is not in the partnership, and father owns all of the relevant property. Wife's 76, so her £1 million exemption we can't use. So the intention is that what remains in the ownership of the father will, his wife will be admitted to the partnership, given a joint share in what is retained, that's a husband and wife transfer, and then the wife will need to be in that partnership for 2 years, because it's a 2-year qualifying period for her to be eligible for APR and BPR in order to secure her £1 million exemption. Something that's important, that again has been well documented in the farming press and elsewhere, is that when you give something away, you can't reserve a benefit from it. So effectively, a gift of land will require an adjustment to the profit allocation of the father in order to reflect the fact that is not perceived to be retaining a benefit from that asset that he's given away. That may be reflecting an adjustment in profit share, for example, to represent what the rent might otherwise be if that land was rented. That's going to require a partnership agreement to be revised. It's going to require wills to be looked at to make sure they're fit for purpose. There will be a loss of income. Father has a pension, so the intention is to access that pension to replenish that income, and that makes sense because it should reduce the value of that pension to hedge against a future IHT liability. Something I would add, and I have a self-interest here, which I declare, the cost of delivering this solution to this family, including accountancy advice, solicitor's advice, and the land agent to provide the values to inform the decisions and do the calculations for CGT, is going to be somewhere between £12,000 and £15,000, which in the context of the outcome represents good value. I'm likely to say that, but it's an indicator of the cost that family farms are going to have to bear to try and get through the challenges that's been presented by the budget. I've just had a 2-minute warning. Gosh, that time's gone quick. My next example is very similar to Farm A. One of the subtle differences here is that the partner capital within the partnership is weighted towards the parents as opposed to the son. And it's important that we focus on land, we focus on buildings, we focus on the farmhouse, etc. But the partner capital balances within the accounts are relevant to the BPR element of the allowance. And that partner capital represents the value of farm machinery, working capital, crop in the ground. So that is in the mix in terms of how that's going to sit in the deceased estate in the context of IHT. So in this particular instance, there's very similar parallels to my previous example, but there will be a gift of partner capital to equalise with the son, because his drawings from the business, understandably, with his family, etc., are heavier than his parents, and his parents are accumulating profit, whereas the son is very much drawing his profit. In this instance, they are exploring the use of a life insurance policy to protect against the risk that they don't survive 7 years bearing their age, and the judgment will need to be made whether that policy is affordable in the context of the liability they're trying to protect themselves against. Farm C is the one with a larger inheritance tax bill. Here we are, we're sort of still in the consultation phase because it's a significant gift of value. There are 3 siblings, 1 in the farm, 2 not. There's a need to get consensus as to how each sibling should benefit. Should the one in the farm receive the land because he needs to farm it, but he doesn't need to own it to farm it? He needs to have a right to occupy it to farm it. So we are considering the possibility of using a trust to hold the land, and we're very much waiting to see the consultation document before making any, try and make the most informed decision as how a trust can play part. In this instance, there are 4 residential let properties. One of those is a more recent investment. That seemed to be non-core, so that asset could potentially be sacrificed to settle inheritance tax if we can't mitigate the liability as much as we would like, or as much as the family are comfortable in the context of giving land and property away. Farm D, this is an interesting situation. I've included this one because it has valuation implications. So parents own some of the land. In a previous succession strategy, part of the land has already been given away to their son, and both parcels of land are let on a sort of a legacy 86 Act tenancy to the farm limited company that sits as the occupant. That has very interesting connotations in terms of valuation, in terms of the value of the land being suppressed by the tenancy. Conscious of time, Bill's appeared on my screen. I'm going to skip through that. I just want to get to my next slide, which is considerations. Obviously, we need to be focused on the succession plan. If, frankly, the farm is not wanted by the next generation, then run the numbers to see whether or not going through the IHT charge with the effective 20% rate is going to be preferable to a lifetime CGT rate at 24%, where in excess of the BADR allowance. I've mentioned gifts without reservation of benefit. Don't assume CGT holdover is available. Letting activities in a farm business can often compromise whether or not that holdover is secure. So that needs a lot of thought. I've mentioned valuations. I think trusts are in the toolbox, certainly, but they do have implications in terms of cost, admin complexity. Banks are uncomfortable in the context of lending trusts, and trusts, depending how they participate in a business, can then compromise the availability of favourable capital allowances. Another interesting point is bank covenants and extent of charges. Where you're looking at gifting land and there's a legacy bank loan, often the charge the bank has over the land is far more than they need, and that charge can be problematic in the context of gifting land. Also be mindful of stamp duty land tax traps where land is gifted and debt is transferred at the same time, because that could be deemed consideration. My final point on that slide is it's very, very important to make sure that your advisory team, as Bill referenced, is collaborating effectively. And I'm enjoying working with my land agent and solicitor colleagues to try and optimise the solutions for clients. Where could this go? Well, certainly at the moment, any lobbying is seemingly falling on deaf ears. Is the age exemption going to be reviewed? Certainly nothing yet. Will the £1 million increase? Certainly nothing yet. There's been a couple of articles around taxation on lifetime gifts. There's been a couple of pieces in the media about, is the PEP 7-year rule going to be extended to 10? And that's certainly a motivator in my example A, whereby we want to get something done before the 26th of March 2025, which is the Chancellor's spring statement. Something being very strongly championed by NFU, CLA is the concept that the tax is calculated, but it's essentially attached to the asset, so that it's there's a clawback tax if that asset is sold at some point in the future. And indeed, the CLA, through their political WhatsApp channel yesterday, sent a campaign notification to encourage members to write to local MPs to support that concept, in the hope that may influence the decision makers before these announcements become legislation. And I'd certainly encourage, where possible, that we do so to try and make sure that we can get this legislation where it should be and not necessarily where it is at the moment. Bill, that's me done, I think. Back to
Nick,
you.
Thank you very much. I appreciate that there's a lot of punchy information in there. I'm not sure if I said it from the outset, but this session will be recorded, so everybody will have access to the recording after the event. We'll email that link out. The link will also be shared on the Suffolk Ag website and the Fram Farmers website, and I suspect the Scrutton Bland too. So don't worry about scribbling lots of information down. Thank you for the whistle stop, Nick. And it needs to move on to our second speaker. So I introduced Will Mitcham, who's a partner at Wilson Raitt. Wilson Raitt, as many of you know, an independent firm of agricultural, environmental and planning consultants based here in Bury St Edmunds. And Will combines his practical experience with over 20 years of providing strategic business advice to arable, fresh produce and livestock businesses nationwide. And he works closely with his clients to see them realise their personal and business objectives. And Will, hand over to you, please, to talk about intelligent SFI. Thank you.
Good morning, everybody. Thank you, Bill, for the kind introduction. As Bill says, my name is Will Mitcham. I'm a partner at Wilson Raitt. We're a firm of agricultural, environmental and planning consultants here in Bury. And this morning, I'm going to be talking to you about intelligent SFI. So let's start by setting the scene. The wettest September to May period on record had the inevitable effect on the 2024 harvest, particularly affecting winter sown combinable crops. The AHDB recently reported that their latest estimate for harvest 24 suggests it was about 13% down on harvest 2023. As Nick has just touched on, the main buzz around the rural sector at present remains the inheritance tax measures that Rachel Reeves introduced in the autumn budget. However, following the budget and almost going unnoticed when it was announced by DEFRA was the reduction to D-link payments in England for 2025. This means that all English farms will receive no more than £7,200 in direct payments this year. And back to the day-to-day coalface of agribusiness, costs continue to rise, challenging even the most efficient businesses to keep their operational costs in check. So what's all this resulting in? Well, it's resulting in cash flow pressure. Some businesses are already staring down the barrel of this, and some, I think particularly those with crops in store, still to sell in the spring, may not feel the full effect of this in their cash flows until the barns are emptied and the shortfall in tonnies and the currently unexciting commodity prices are realised. And of course, these are not the only pressures and challenges that farming businesses face. Growing and storage risk, think oilseed rape, think fusarium in onions, climate, price volatility, labour scarcity, labour cost, the supply chain, highly geared businesses struggling to service debt, the threat of those businesses who rely on water, pests and diseases, carbon, legislation, the list goes on. This next slide is an extract from DEFRA's Farm Business Survey that was published in November 2024 and covering the 2023 harvest year. To me, there are two main takeaways from this graph. Firstly, farm business income from cereal farms at £39,400. That's the little black dot in the teal on the top section of the graph. At £39,400 represents a 73% reduction from the previous year, with cereal farms now recording on average a loss of £26,400 from their farming activity. This loss on the core activity of the business is being supported by BPS monies that average circa 26k, diversified income at a similar sum, about 26,500, and agri-environmental scheme payments at £13,200. The second takeaway for me is the void that is left if you remove BPS, highlighting really the importance of diversified income and income generated from agri-environmental schemes to farm businesses' profitability going forwards. This does spark a whole separate debate about diversification supporting loss-making farming businesses, and of course vis-a-vis supporting crop production, but that's for another day. So, having set the scene, what has that confirmed to us? Well, it's confirmed more than ever the need for us to construct financially sustainable businesses, businesses that generate cash, businesses that are profitable, businesses that are agile and flexible to adapt quickly if required to change. Businesses that understand that it's about maximizing your own resources, the unique cards that you and your business have been dealt. A financially sustainable business understands that it's all about sweating those resources that you have available to you. And of course, it's not just about land and property, it's about the people too. So in the context of the Sustainable Farming Incentive, what does this mean and where do we start? How do we harness intelligent SFI to help us create financially sustainable businesses? Well, we start by creating a baseline. So that's the first key takeaway from me from today's presentation. How can we look to improve when you don't know what you've got and what's your start point? Remember, of course, that your assets can be environmental features and they're not always a hindrance. And as business owners and managers, our task here is to optimize every resource available to you. And whilst we're talking specifically this morning about SFI, the same principles apply to optimizing every square meter, every building, every asset within your business. With land, I encourage clients to think about land in blocks of 1 hectare or half a hectare. Think of each one as its own cost center, its own production silo. Intelligent business management and intelligent SFI allows us to optimize that cost center. Is that cost center optimized by growing crops? Is it optimized with an agri-environment scheme? Is it optimized by something else? Should we be doing nothing? Make every hectare count. I'm a big advocate of using technology and software to inform your decision on where your productive and non-productive areas are. What's your gross margin from farming? What are your costs of operation? What is your net margin? What's your farming baseline? Don't just look on a field by field basis either. Try and break it down further if you can to parts within a field. And don't just rely on gut feel. Gut feel will tell you that the north side of the wood is wet, but does data support that? And does data confirm that? In most situations, proper data will, but as I touched on earlier, the stakes are just far too high to make decisions without having good, reliable information to steer you and inform those decisions. You must really ensure that thorough and proper due diligence is undertaken. So intelligent SFI isn't just about putting in place a scheme that optimizes land under your control. It also presents an opportunity to optimize the whole of your farming system. At the core of generating cash-generating businesses is the need to operate in the field as efficiently as possible. We often talk about economy of scale, and for many, there's an assumption that economy of scale is all about getting bigger and spreading costs. Well, it's not. It's about hitting a sweet spot of scale that allows you to optimize the resources available to you, primarily your men and your machines and your infrastructure. Intelligent use of SFI could allow a business, for example, to descale to reach peak operational efficiency and profitability. And as well as effects of descaling, you may also see other benefits such as reducing work pressures at key times of the year, perhaps easing crop storage pressures, and also effects of reducing risk to your business and fixed and working capital demands. So I'm going to start here with a statement. And to me, the second key takeaway from me from today's presentation. Everyone, at minimum, should submit an SFI application and be doing what I and our team would call the basics, starting with the management plans. There simply isn't a business that I've seen where some of the features highlighted on this slide for either existing cropping or existing features cannot be undertaken with no or very limited adjustment to existing business practice. For me, it's simply a no-brainer. As well as that, utilising payments for companion cropping, for example, and cover cropping also provides agronomic benefits. Whether these are payments for something you're already doing or providing the opportunity to try something new without the financial risk, everybody should be doing the minimum. I'll reiterate, to me, it's simply a no-brainer. So we spoke earlier about key takeaway one, creating the baseline. So having undertaken your baseline assessment to understand the net margins from each of your little cost centers, your production silos, the next stage is to compare it to the options available to you under the SFI scheme. So this graph just picks out a few of the more popular options, highlighting the gross income, the costs, and the net margins from each. A number of the options now have an application cap, meaning that you cannot apply for more than 25% of the farmed area under these options. So that being said, there is a possibility to look at swapping a standard crop out for a stewardship crop. For example, unharvested cereal headlands projects the highest net margin at £892 per hectare. Floristically enhanced margins or plots have a net margin at £641 per hectare. The key here is knowing your numbers will help you put together an intelligent application. Really importantly here, key takeaway 3 from me about intelligent SFI. Intelligent SFI is knowing when to use SFI, but equally when not to use it. So this next slide illustrates how you can be intelligent with your establishment of SFI options. So in this example, we're choosing a seed mix that includes kale, which can provide 2 years seed sources for a winter bird food mix and results in a favourable increase in the net margin of about £71 per hectare. Another example of intelligent establishment is allowing areas to naturally regenerate, which will save on the cost of establishment. One main difference with SFI is if you have previously had an option established under another scheme, once that scheme is ended, and on the basis that it's still meeting the actions and aims of SFI, the environmental prescriptions, you can continue to use it. So the point here is that there's no need to pull up a perfectly decent nectar or flower mix to simply just re-establish it in the same place. Be intelligent with your establishment. Conversely, you may be coming into a new SFI carrying a liability from a previous scheme. Probably the best example of this is a legume fallow used to control blackgrass. Where this hasn't worked, you now face a difficult decision. You can keep it in legume fallow, where the problem will likely get worse, or you could try to crop the area where you possibly lose money in trying to control the blackgrass, or consider another SFI action, or try a different approach, test and adjust what you're doing and see if you can see an improvement. Sometimes there is no simple or easy answer. Only trial and error and getting the best possible advice to help you inform your decisions is the way forward. So be intelligent, and importantly, look what has worked well for you in previous years and schemes on your land, in your situation, on your resource, and utilize that knowledge going forwards. So on this next slide, we can see a plan of a farm. It's around 266 hectares in total, split between 184 hectares of arable and some 82 hectares of permanent pasture. Remember my earlier comment, intelligent SFI is about understanding your resources, creating a baseline, and selecting options to put in. Oh, my slide just moved. And also what you might want to leave out of SFI with knowledge that there are other schemes available, not just the SFI. So moving on to the next slide, here we're focusing on the arable block on this farm. I'm not going to go into detail, but intelligent SFI has been used to optimize efficiently in the field. Intelligent SFI has also been used to understand the options that are available to the business. In this case, delivering for local priority habitat and species can often provide the best margin. And we also know that establishing habitats in the right location and where they want to go often results in lower establishment and management costs. So this particular farm is in the Brecks, where allowing areas for rare plants to grow and nest creates environments for stone curlews, which is encouraged. In this case, cultivated margins are a perfect action here. They suit the sandy soils and they provide habitats for both species. Without going into detail, this farm introduced a balance of habitats and food sources across the farm. And as a result of the scheme, the business was also able to rejig its labour and machinery profile and inventory, allowing it to optimise economy of scale and achieve top 10 operational costs. SFI payments now made quarterly, providing regular cash injections throughout the year, helping to manage finances and cash flow. I'm probably going to just jump over the next slide as I think we're getting under a bit of time pressure. But I think the key points here is that, remember my key takeaway earlier, that intelligent use of SFI is knowing when to use it and when not to use it. So in this case, countryside stewardship higher tier made much more sense financially and environmentally, and SFI would have been a mistake. So by using the correct combination of schemes on the farm, the combined income from higher tier stewardship and SFI was circa 74k in this example, and we took out about 13 hectares from arable production, which of course was the least productive land. We're in the Brecks as well. For context, the farm was receiving circa 60k from BPS, and if we would have put in a scheme for SFI only, the income would have been about 46k. So let me just move to sort of try and wrap all this up. So to conclude, really, intelligent SFI starts with sound basic principles. Understand your resources and understand and take ownership of your numbers. There is no reason why everyone should not at least be doing the basics and capturing the base level of income from the SFI scheme. Intelligent SFI is knowing when to use it and equally when not to use it. be intelligent in your option selection and be intelligent in how you establish and manage those options. Intelligent use of SFI is taking the opportunity to be part of the scheme whilst it is still with us and at current payment levels. Many of us can, I'm sure, think of schemes where the early adopters benefited from enhanced revenues, feed-in tariffs, others similar, and also situations where schemes simply closed overnight, often without warning. So don't lose sight of that. And finally, from me, and it's absolutely important in everything you do, SFI, business, life, be committed. Without commitment, you're pretty much destined to fail. So thank you very much, and look forward to any Q&A later.
Will, thank you very much. Sound advice and succinctly delivered, so thank you for that. And a reminder, as Will just said, that if you've got any questions, please post them in the Q&A and we will get to those at the end of the session. So moving on to our third speakers, we're a double act now with Roland Bull and Lisa Bulmer from Bidwells. And the subject is Navigating Biodiversity Net Gain. Roland's leads a team actually delivered the first successful planning consent using biodiversity offsetting in the Essex pilot scheme and one of the first nationally. And Lisa advises on ecological enhancement and management, providing strategic advice on sustainable investment. She's the right mix of industry insight and passion for the environment, and she helps developers, landowners and local authorities and conservation NGOs. So over to the pair of you, please. Thank you.
Thank you very much, Bill. Yeah, that's right. I'm a partner at Bidwells based in Cambridge. My main role is heading up the rural investment team, where we look after about £1.5 billion of land and associated rural property, principally for institutional investors. But I studied studied ecology as an undergraduate, and so have spent the last 15 years or so working on largely sort of contractual and financial structures associated with large long-term habitat restoration and management projects, particularly related to development. So when we saw the introduction of statutory biodiversity net gain a few years ago, I wanted to sort of build on the experience that we'd gained really over the previous 10 years and brought Lisa on board, what now, 3.5 years ago, Lisa?
Yeah, that's right.
And Lisa has done a phenomenal job since in developing what is now really a leading team in the country, acting for some of the largest landowners, some of the earliest schemes onto the National Register. So we've developed out now a portfolio of about 35 habitat banks nationally, principally for landowners who are delivering them themselves, where they have the management resource to be able to physically create and manage habitat, and so we sort of work with them through that process, establishing habitat banks and then trading units. So over to you, Lisa.
Thanks for having us speaking today. You might have quite a varied understanding of what biodiversity net gain is, and so I'll briefly go over that at a pretty high level just to get everyone up to speed on it. We'll cover over some market insights and then delve into what makes a good biodiversity net gain site, so you can start to think about your own land in this context. We'll touch on what the spatial risk factor is and why that's important to consider. And then Roland will delve into more deeply the different delivery models and key considerations for taking forward a BNG scheme. So biodiversity net gain, it came about just over a year ago now into legislation for developments in England to deliver at least a 10% gain in biodiversity, which is measured by essentially the habitats that are there. So a development impacting habitats because of their footprint of that development scheme has to then go above and beyond to replace that. And the Environment Act pushes for them to be as much on site as possible within the development site boundary, and then where they can't deliver all of the 10%, they have to go off-site to deliver the rest of that habitat. It requires a legal agreement, especially when you're doing that off-site as a BNG provider. You're committing to 30 years creation and ongoing management of those habitats. It differs from countryside stewardship and SFI in the fact that it's not only your inputs, but you must achieve the target outputs. So you're committing to delivering certain habitat to a certain quality and condition. And so you really have to think, do you have the resource and ability? Have you got the right specialists on board to help you get there? And it's regulated by either local planning authorities or responsible bodies. And we'll come on to that in terms of, what legal agreement you might go down. So biodiversity net gain, it's measured with a biodiversity metric. DEFRA and Natural England have created this. I've given a quick example of what the outputs of the metric are, but essentially if you're taking 20 hectares of cereal crop, converting it into a grassland, you're looking at about 6.5 units a hectare, and they're biodiversity units that you're generating. So the metric looks at each habitat type, what its condition is, where it's located in strategic significance. So that essentially means, is it close to, skipping along, is it close to existing environmentally designated sites, river courses, priority habitats? That increases its strategic significance, and that is incentivized because of that bigger, better, more joined up nature and nature restoration in our landscape. There's also some risk factors involved in there as well. As you can imagine, to create a woodland from scratch, there's a lot more risk in tree failures than it is creating grass meadow, where there's more likely chance of success of grass seed taking off, just generally. So that is considered when you're getting these units out of the metric. And ultimately, it's just, what's your baseline scenario? What are you trying to achieve in the outset? And one minus the other gives you what your uplift is or loss. If you happen, say, to be putting in a track, you're making a loss there because you're replacing habitat with hard standing. So hopefully that gives a bit of an overview. So market insights. Actually, I sent this presentation away a week ago. Since then, I think we're now over 50 in terms of registered sites. So it really is a really rapid marketplace at the moment. A lot of sites are going on the national register. So these are BNG dedicated schemes, providing habitats specifically for developments that need to offset their impacts. Once they're on the register, that means that they've got their legal agreement in place and they're able to market the units that they're generating, or they may have already allocated their units to a development. A lot of the sites that we're working on, it's landscape scale, and so actually one BNG scheme might be serving multiple developments, and that's the way we set them up. There's a lot of demand for grassland and scrub units, so that plays into the trading rules of the metric. So developers have to offset like for like or like for better. And as you can imagine, a lot of developments across the country, the baseline for their development sites are often either arable or grass pasture. Some might have some scrub areas. There'll be hedgerows as well, but often they can be quite easily incorporated on site into the development design. So that tends to be what we're seeing a real high demand in, but you do get others, say infrastructure projects are really forced in their trajectory of where their footprint needs to be, and they can't avoid impacting woodland, for example. And so then you do come across some developers needing those bits of more high distinctiveness, more difficult to create habitat types. We've noticed with the way the metric is designed, it actually incentivizes enhancement of woodland over creation of woodland, because it takes away that risk factor from the outset of failures in plantings. If you've got a woodland that you've not been managing at all, or you've just been sat there ticking over, and actually you could create a lot of units by going in, doing some thinning, leaving some of the dead wood, and that can create a lot of units, especially if it's a vast woodland or you've got many patches of woodland across your estate, for example. So it's a good way to add in if you've got, you know, an arable field and some woodland stands as well that you can incorporate into a scheme. There might be good potential there. Unfortunately, if you've been doing a great job at managing your woodlands to date, there maybe isn't much uplift to be had. And that's just the way of BNG and how this is working at the moment. On to pricing and what you could get from delivering this habitat creation enhancement. So it does depend on those habitat types and the availability nationally. So where you've, you know, most of those 50 registered sites will have grassland and scrub units, and so they're going to be priced competitively. And you know, I've put down there 25 to 35,000 for grassland units. We'll come on to spatial risk factor in a little bit, and that will play into whether it's at the higher end or lower end. But where there is demand, you're looking at that lower end of where there is competition with supply, then you're looking at that lower end of the scale. But ultimately, is very attractive in terms of gross revenues. You obviously have to consider that this is 30 years of maintenance you're going to have to be delivering, so that cost has to be put in there. If you're looking at acquiring land for this specific purpose, you've got to take into account the cost of acquiring that land as well. And ultimately, when it does come to great competition in the market, you probably would be outcompeted on those, say, estates that aren't taking into account their land value because they have no interest in ever selling their land on. But Roland, I'm sure we'll cover that a bit more. Anything you want to add at this point, Roland?
Don't think so. No, it's, I
On.
think we need to rattle through it.
Yeah, well, I want to get on to the key considerations, which is maybe most helpful and beneficial. So what to look for if you're looking at your own farm, your estate, what should you be looking for in terms of identifying site for BNG? I mentioned ecological strategic significance, the plan on the right here. And the red line boundary is one of our BNG schemes. It's a 140 hectare farm, half of that, 70 hectares, we've put into BNG, really vast site. And the brown areas are triple S size, and you can sort of see you've got a large triple SI in the west, and actually there's a Roman road that follows out south east, running parallel to the south of this site, which is calcareous grassland, is one of the main reasons why it's a triple SI. So, you know, it lends itself to buffering that and enhancing that. It's part of the Cambridge Nature Network that the Wildlife Trust has identified. So it really is strategically significant. It's going to be a great stepping stone for wildlife conversing across the landscape. Also being in Cambridgeshire, there's obviously a lot of high development pressure there. So we're expecting, you know, a lot of demand. We're already seeing a lot of demand for the units there. And we've made several sales already for units in this site specifically. The baseline, so this was an arable field initially. So there's really good uplift potential. You know, we're getting around 6 to 7 units per hectare generated. And because of its scale, we're tapping into grassland, scrub, hedgerows, woodland. There's quite a variation of habitat types that we can offer, so developments can meet requirements. The scale allows for that, and it means we can be cost effective about this. So concentrating resource into this landscape, when ecologists come to do the monitoring, they're doing it across the entire landscape in one day. So that's really beneficial because of its scale. And most importantly, actually, is that it has a low alternative land use value, that your site couldn't be used for development in the future. You might be impinging on that potential if you do BNG on an area like that, because you've 30-year commitment there, and you're increasing the environmental value of that site as well. So although we say it's a 30-year commitment, really you're not going to be putting it back into cropland at the end of 30 years without having to go through a lot of extensive EIA work to evidence that you're not going to be damaging too much nature by turning it back to cropland, and that's not really the point of BNG either. And your ability to put some wider benefits is helpful as well. It's not part of BNG, it's not mandatory to be delivering social benefits, but you do get some well-established development companies, say National Highways, etc., who want to go above and beyond, want to know that their off-site BNG is contributing to the communities where it's located. So, for example, this site in South Cambridgeshire, we're extending permissive footpaths around the site, putting in some signage for education, and it all just really makes the most out of what you can deliver here. Trying to get the next slide. I've missed one. Sorry. So I've touched on this a little bit, the spatial risk factor. And this is really in terms of trading your units and making sure that where you're located is in an area where there's development pressure and that demand to meet your supply of units. So this map shows one of our schemes, Wiston Estate. It's located in the South Downs National Park Local Planning Authority area, but also it's located in 2 national character areas. It straddles the South Downs and Low Weald national character areas. And you can find this, you type into Google England national character areas, you can get a plan of that. We've also got an interactive map on our website that helps with that. But importantly, if a development is located in any of those specific areas, in the white areas on this plan, they can purchase units on a 1-for-1 basis. So if they need 20 grassland units, they would only need to purchase 20 from Wiston Estate. If they were in this catchment, if they were in the grey, they'd have to procure more units because of the distance, I suppose. It's not really as the crow flies distance, it's more in terms of these catchments specifically, and so on and so forth. So it's just worth knowing that, and also worth knowing, from competition in the area, how many other BNG schemes might be in your same catchment where you're trading on that same basis as well. Ultimately, developers want the most cost-effective option for them. They would push for proximity as well. That's a key part of what they're after. So it's really worth understanding that. So I'm going to pass over to Roland now to just go into the mechanics of setting the scheme.
Thanks, Lisa. So yeah, 3 sort of key models here that people can pursue. The one people are probably most familiar with is leasing land to a third party, where the Environment Bank are probably the best known example, but there's lots of other similar ones that have established now where effectively they will pay a rent for a 30-year period to take a lease and typically contract back for the delivery of the physical management. One of the key points to understand here really is what risk you are sharing with them for the value that you're sharing. So I normally break risk under BNG agreements into 2 buckets. One is the delivery risk and liability, i.e. the likelihood of not achieving the outcome that you've committed to in terms of habitat, and the consequences of that in terms of sanctions that are imposed by the local authority or the responsible body under the management agreement that you've got. And typically with these third-party agreements, actually, while they'll tell you that they'll be carrying that risk for you, they really do contract most of that back to you under the management agreement. So you're not really foregoing any of the delivery risk and liability under that type of arrangement. What you are foregoing to an extent is depending on how you share value, is the commercial risk, which is the uncertainty around speed and value of credit sales. But as I say, you are sharing a significant proportion of the potential value that's created in order to get a bit more certainty on the revenue. But even in the landowner-led schemes, there are various ways that we can ensure that you manage that commercial risk through commencement notice provisions, so that you're actually not committed to delivering anything or any of the significant initial costs until such time as you've actually secured a meaningful credit sale that can vindicate that decision. And similarly, we'll typically incorporate unilateral termination provisions that allow you to step away from the obligations in relation to the land that you're yet to actually receive any value for under credit sales. So say there are ways we can protect against that commercial risk under landowner-led schemes. Sort of group schemes, various different ways of doing this, but certainly some of the landscape recovery projects, we're working quite a number of large landscape recovery projects in different parts of the country where there's sort of multi-landowner schemes looking to share value, but also where you can work with third parties like conservation NGOs to deliver some more complex habitat types. And there's a whole variety of different contractual structures and ways in which value can be shared. The final one there is what we've pretty much universally done with landowners is to work with them to establish their own schemes where they're in full control. They're committing the land to a local authority. As I say, we put those measures in place to try and protect against some of that commercial risk, but they then derive all of the value. So that certainly is the way we're seeing landowners achieve the best outcomes in terms of control and financial return. Key considerations here: VAT, sort of well-established principle now that compliance markets will attract VAT. I mean, it's actually beneficial insofar as if you're VAT registered, you can obviously, because you're charging VAT on the sale of the credits, it doesn't compromise sale value because the purchasers themselves will all be VAT registered and recover the VAT. And obviously it allows you then to recover the input tax on any costs that you're incurring in scheme establishment and management. One of the key things is whether the revenues themselves are treated as income or capital. Typically what we will try and do is set up corporate structures where the freehold landowner will lease the land to their own corporate. What we normally do is have both the corporate and the freehold landowner as party to the Section 106 to give the local authority confidence that they have recourse to the underlying landowner. And what that allows you then to do is not put in place necessarily a 30-year lease with the corporate, so you're able then to unwind it after a relatively short period if you wish, without incurring a stamp duty and capital gains tax, corporation tax liability for an arm's length surrender consideration. But then what that allows you to do is collect the revenue within the corporate, have it taxed at corporate rates. We've had confirmation from HMRC. We've filed accounts now for corporates that have been set up purely for BNG purposes now. And we've had confirmation that the tax treatment effectively follows the accounting treatment. And where the agreements are structured appropriately, you can effectively smear a big lump of upfront revenue that you've collected from credit sales on day one across 30 years. So effectively, you're bringing 1/30 of that large sum of money into tax each year. So where you've incurred some costs up front in setup and capex potentially on some fencing costs and things like that, you're probably not paying any tax on that until maybe year 2 or 3, after which you're paying, you're only bringing, as I say, 1/30 into tax, which is really having your cake and eating it. I mean, it's a fantastic outcome. And then what you're able to do is keep that capital within the corporate, and there are no controls over it. Most of the agreements we've set up don't place any controls on that in terms of holding cash in escrow or sinking funds for long-term management, which allows you then to use that cash to invest in other parts of the business. Just in terms of, valuation, key point, lots of people get concerned about diminution in value. I mean, that can be a concern in certain circumstances where you're diminishing the productive capacity of land. But the reality is the example Lisa gave, if you're generating 6 units a hectare at 30,000 a unit, you've got 180,000 of gross revenue, that should have more than compensated for you for any, loss of capital value that you suffer over that period by creating, biodiverse habitats. Risk and value sharing, I'll probably just finally cover that one. As I mentioned, there are lots of circumstances where there is merit in working with third parties, and particularly for more complex habitat types. And we've come up with some quite interesting ways of carving up, risk and value depending on how well individual parties are placed to carry that component of risk. So, for example, where we're working with big institutional investors, they're well placed to carry some of the commercial risk in terms of speed and value of credit sales, whilst they may be working with either a landowner or a conservation NGO who are very familiar with the land management components. They have all the physical resource to do that, and they're better placed then to carry some of that delivery risk and associated liability for the commitment on long-term outcomes. So I think probably we're already over time, so I think we probably ought to wrap it up there.
Lisa, Roland, thank you. As with the previous topics, there's so much to cram into a short space of time. I appreciate you going through that. And of course, you are and will be available for anybody that's interested, I'm sure, to take on individual advice at any point. So thank you for that. We'll now move on, if we may, to our final presentation. I introduce Liz Martins from HSBC, who will look at the general economic outlook. Quick biography of Liz. She joined HSBC in 2010 in the Dubai office, where she covered 15 Middle Eastern economies during a very turbulent period of the Arab Spring. She moved to London in 2014 and has to join the Global European Economics team. Since 2016, she's led HSBC's analysis of the UK economy, including the key task of navigating the economic landscape following the UK's vote to leave the EU. She holds a bachelor's and master's degree from Cambridge University. Liz, over to you, please.
Well, thank you, Bill, and good morning, everyone. First of all, caveat that, like as was just alluded to, in economics as well, there's a lot to talk about today, not all of which we've got time for. And of course, the world is changing so rapidly that almost the slides that I put together last week, the world has already moved on. So I'm going to race through the slides that I've already got, and then people want to talk about tariffs or increased defence spending or World War III, then feel free to ask that in the Q&A. So let's start with the UK economy, though, as we currently stand. And I'll start with the good news, because it's not all good news, I'm afraid, and some of this will be a little bit depressing. But the good news is, of course, that, we're coming out of what has been a painful cost of living squeeze, whereby inflation has risen by more than our incomes, and we effectively became poorer thanks to inflation. But for the last kind of year or year and a half, that's flipped over. Wages have been rising faster than inflation, and we've been recovering some of that lost ground. So it's not like we've all won the lottery. We've kind of broken even on where we were at the start of 2022, but we'll take it. That is a good thing for the consumer. However, what we are lacking at the moment from a consumer perspective is confidence. So you can see the consumer confidence side on the left-hand side. People are still hungover from the cost of living. Some people have still got rises to come in their mortgage payments. And generally speaking, people are nervous. People have lots to, I guess, worry about geopolitically, domestic politics. And somehow, the animal spirits that you might expect as we become better off haven't really materialized. For companies as well, it's a tough kind of time. I think companies have come through a lot in the last few years: Brexit, COVID, Ukraine, big staff shortages, the mini budget, you name it. We've had a lot of shocks in recent years, and British companies have been incredibly resilient. But just as we're kind of coming out of that environment of all those shocks, along comes the government with this big tax rise on the national insurance. And you can see from this chart that only a very small percentage of companies said that they would do nothing in response to the tax rise. So, I don't know whether the government kind of expected it to be less of a big deal, but a very small percentage of companies said, actually, this is no big deal, we can just carry on as normal. For the majority of them, they will be taking one or a number of the steps on the right-hand side. So higher prices, passing the costs on to consumers, cutting headcount, reducing profit margins, reducing wages, whatever it is. These are not really nice options for companies or for the broader economy. And then if I think about the pillars of the economy, I've talked a little bit about consumers, a little bit about businesses. The government is the third pillar of the economy, and the government actually is doing the heavy lifting for growth. I don't know if people were aware of the number that came out a couple of weeks ago on GDP growth, whereby we were all celebrating that GDP was plus 0.1, not minus 0.1. So we're not in recession, we are still growing, but actually it is the government that's driving that, and that's all fine, except that when we come to the spring statement, actually the risk is that Rachel Reeves is going to have to say, well, we're going to have to scale back a little bit on the spending that we're doing, because number one, the Office of Budget Responsibility might come to her and say, do you know what, we might have been a bit over optimistic on what we were expecting for GDP growth. That's in the chart on the left. The OBR was looking for 2% this year, almost 2% next year. And of course, bond yields have gone up. And actually, this chart is a few days old. And on the back of the news about German defence spending and other developments, we've seen that push even further. So the worry here is the government is the only kind of cylinder that the UK economy is really firing on at the moment, and they might have to scale back, you know, come the spring statement or perhaps further down the line due to this rise in bond yields. So you put all that together and you kind of think, well, the only sort of way that this can improve really is for the Bank of England to come in and provide some support for the economy. You know, consumers, businesses, and the government all kind of faltering. You need a little bit of help here. And yet you can see the red line here is the market pricing on rate cuts. And the market has really come to the conclusion that we can't have many more rate cuts. So our own forecasts are a little bit more optimistic. As you can see, we think that the pace of rate cuts will accelerate to provide some support for the economy in the latter half of the year. But you don't have to take my view. You can take the market's view instead if you want to be a bit more pessimistic. And on that view, you know, rates aren't going to fall much further at all. Maybe actually, I think at the moment on the current pricing, it is around 2 more cuts from 4.5 to 4%. And there's reason for that pessimism. The BOE in its last update said that actually we all know we were going to have an inflation hump. So inflation has come down from 11%. It got as low as 1.7%. It's now bounced up to 3%. And we all know that it's going to continue to bump up through 2025. The problem is that for a variety of reasons, like natural gas prices, global food commodity prices, water bills, etc., now that hump is not going to be in the high 2s, it's going to be in the high 3s. And considering the BOE's inflation target is 2%, that of course does complicate matters when it's thinking about cutting interest rates. So ultimately, it will be a question of whether it thinks those inflation pressures, things like your household energy bill going up, your supermarket shop going up, your water bill going up, whether that translates into kind of a vicious spiral in the economy. Now, we don't think it will, and the Bank of England don't think it will either. And the reason for that is that we are in a very different economic backdrop to the one that we were in when the first wave of inflation hit. So in 2022, and, you know, gas prices soared and sparked the whole inflation episode. At that point, you know, you had a very strong jobs market. You can see in this chart, these are just different indicators of employment. And we had a jobs boom post-COVID, but that boom has largely fizzled out now. And the question is, you know, can people sustain this kind of inflation spiral? If, you know, because an inflation spiral happens if you say, well, look, my water bill's gone through the roof, my energy bill's gone through the roof, I need a pay rise. I go to my company, I get my pay rise. That company's costs have gone up now, so they pass that back on through their prices. And now inflation's gone up, so I need another pay rise. Now, we don't think we are in that world, because we think companies aren't going to be able to deliver those inflation busting pay rises that people want. We also think if they try to pass on their higher costs, they will find that consumers resist it, because, you know, we've had such a tough time from all the inflation that we've already had. So that's kind of where we are. It's not particularly upbeat, but let me finish off by trying to be a little bit more positive. You know, I think for one thing, we have a government that does have a lot of pro-growth plans in place. It wants and needs to grow this economy. And I think one of the things it kind of lacks actually is a good PR operation, or maybe a hype man or something like that, because actually there is lots of good news out there in terms of government initiatives for growth, but they're not probably people aren't probably as aware as they maybe should be. So things like the pension reforms, things like house building, things like attracting that investment, things like deregulation, and also on the reset of EU regulations. I mean, that's an interesting one. The UK potentially could find ourselves in quite a positive position here. We're not in the EU, so we will not be subject to any tariffs that are placed on the EU, nor if the EU retaliates to those tariffs, do we have to do the same. In fact, President Trump, when Keir Starmer went to meet him a couple of weeks ago, was talking about a special deal for the UK. On the other hand, it's going to be a diplomatic tightrope trying to maintain relations with both the US and the EU. But if we can do it, I do think that puts the UK in a really good position. Just to hone in on one of those policies, of course, the house building and the planning regulation reform. This government has set an incredibly ambitious target in terms of house building, 1.5 million homes across the Parliament. If you're going to do that over in year 5, you probably need to be doing 370,000 a year, and you can see from this chart how very far away that looks as a target. The last time we were doing that kind of number was the late 1960s, early 70s, at which point you can see the local authority was doing about half of it, which it probably doesn't have the money to do now. And B, of course, there was a lot of slum clearance and demolition happening there, so there was more land that could easily be built on. So it does look very far away and hard to achieve, but why do you set a very ambitious target? Maybe you set it so that you can make as much possible progress as you can towards it. And ultimately, the policy aim is a good one. I know people don't love the idea of having a housing state viewed out of their backroom windows, but we do have less housing than our counterparts. And I think a lot of the UK's problems probably do go back to housing affordability. So if this can be make a dent in that, then I think that is the right aim, along with a lot of Labour's other policies around infrastructure, around the energy transition, around supporting the economy's kind of key sectors. So that's really it. It has been a gloomy start to the year. I mean, I haven't really touched on the geopolitics, but as I say, you can ask in the Q&A if that's what you want to talk about. But there are reasons to be cheerful as well. We're not in recession. We are growing. We're hoping that inflation increase is temporary and doesn't have second round effects. We're hoping that some of those government policies might bear fruit, and possibly, maybe just maybe, if we're right, we'll have a few more rate cuts than the markets expect. And the final point is that there are always risks. Economists like to say uncertainty is particularly high. It isn't really. Uncertainty is an absolute. There is always uncertainty, and at some point, I think we just have to get on with it. So with that, I'll leave it there.
Liz, thank you. Again, another whistle stop. Never a dull moment in the banking world with so much going on politically. Right, moving on to Andrew, who will host the Q&A session. Andrew, if I could hand to you, please. Hopefully we've had some questions come through in the Q&A. I know some have been answered as we've gone on, but perhaps you could highlight some of those and expand on them for the benefit of all, please.
Okay, thanks, Bill. Thanks all our expert speakers. A huge amount of topics, knowledge and advice covered there. As Bill has said, we've had a raft of questions come in. Many of those have been already answered by our speakers on the fly. So click in to have a look at those answered questions. I'm just going to pose a few quick ones. And can I encourage our panel to be short and concise in their responses? So opening the batting, Nick, one over to you. Thanks for all those great case studies. What's the situation? Are you coming across family farming businesses, maybe with the partners, directors, early mid-50s, the succession be maybe in their teens? Are they taking the attitude, hunker down, don't do anything, hope the change in government and reversal of these policies? Or is your advice to them also to take action? Don't disappear off the screen.
Sorry,
there we go.
I just realised I plugged my laptop in, but forgot to turn the plug socket on. And I think the answer there, Andrew, is I think there's time to wait. That there's political gain being achieved at the moment by opposition parties saying that they're likely to review what's been announced and potentially repeal it. Obviously, it's easy to make those statements in the first year of opposition of a 5-year parliament. And will they have such conviction nearer the next general election? And can we expect, once legislation is on statute books, how many instances are there where it is repealed? So, I think there's the likelihood that these sort of inheritance tax implications on farms, land estates are likely to remain, but certainly those clients in their early 50s and indeed early 60s, we're not necessarily advocating they have to take action. Clearly, we're advising where they wish to try and do something. Minor children, as you've alluded to, presents challenges in the terms of gifting assets. And of course, the next generation of that age have quite a number of challenges to encounter over the coming years. Understandably, there's a nervousness to transfer assets of significant value. Those assets ultimately be at risk and potentially cost the family more should they leave the family domain through divorce or otherwise. So certainly life insurance, I think, is something to consider in those circumstances, as I mentioned in my presentation. But there is time to consider, so one mustn't panic.
Okay, Rachel's popped a question in. What is the accountant's view of joint ownership deductions on company shares, which may be held over for several family members? Quick one for you there, Nick.
Yeah, I think that I'm assuming that's driving at whether the shares can fragment the value of a company, and in circumstances, yes, certain circumstances, yes, those shares can secure minority discounts. So effectively, if you own 20% of £1 million company, those shares aren't necessarily worth £200,000. They could be worth significantly less through the application of minority discount. It sort of tunes into some of the points I was trying to make reference to in the anti-fragmentation rules and the trust consultation. Obviously, HMRC or the Treasury will be alive to this strategy, so expect some potential changes to how valuation principles will apply where there's common ownership of the same asset within the same family group.
Okay, right, one for Will and Roland and Lisa from me. We talked about intelligent SFI, we talked about BNG. What is the first step in deciding which route to go down? Because sometimes it might be that a BNG option is slightly more attractive than, say, the SFI. So how best to approach that conundrum of which avenue to pursue? Who wants to grab that? Will first, and then over to Roland and Lisa.
Okay, thanks, Andrew. From my perspective, I think their SFI probably feels a bit more here and now in terms of the length of the scheme, and perhaps its application and integration to what I would describe as sort of a working farming business. Maybe as a generalization to me, that the BNG application probably is more applicable to specific geographies, specific objectives of the owners, proprietors of a business, and their ambitions going forward. So in many ways, I think they feel a bit mutually exclusive to me. I don't necessarily think you'd go down the route of looking at SFI first and then BNG or vice versa.
Yeah,
Okay.
I concur with that, Will. And I think it's not a case of if you're doing BNG, you can't also do SFI elsewhere, or perhaps even on the same bit of land, as long as they're very distinct actions and you're not being paid twice for the same thing. They can run side by side. So it might be that it's a combination, but I think Will's absolutely right. It's very dependent on the farm and the estate itself and what the long-term strategy is for that landowner.
Okay, that's clear. And just sticking on BNG, Lisa, are you seeing that the client base engaged in BNG are these individual businesses and estates, or is it more groups of landowners coming together?
We're seeing more of the former. There is certainly interest in groups, and I think there's a few of them now from farming groups that have come together, landscape recovery schemes as well, looking into that. It becomes, you have to have a really complex and comprehensive business model around how you're going to share and manage risk and value, which is far more complex, and ultimately as neighbouring landholders you could be considered in competition with one another as to who the unit comes from, what plot of land, and who it's tied up to, but it can be done, and we are working on that for a few landscape recovery schemes, but it's certainly not the 50 that are on the register is not that group scheme.
Okay, thank you for that. We've got a question in from Bruce. Is it possible to stack BNG under field-based solar PV schemes as the timings are aligned with 30+ year leases? One for you, Lisa.
Yeah, technically, yes. However, it's very important that if the solar received its planning permission because of the surplus BNG that it was going to be delivering and converting an arable field to grassland, for example, if that's part of its planning approval, then you can't then sell it on that surplus. It would have to be really distinct in your planning application process that you're carving out a surplus. Or if you're delivering 30% BNG, that extra 20% would be available for ongoing sale. So it can be done. I don't think we've seen it done yet, because ultimately you're getting far better rates from the solar, I believe.
Fantastic. James Black's mentioned lens funding, and is there and there's been some suggestion it's possible to stack lens and SFI options. Is there any truth in this? Is it worth considering? One for you, Will, I believe.
Simple answer from me, Andrew, is I don't know the answer to that. I've heard similar comments to that James has mentioned, but I can't sit here with authority and say that it's possible.
Okay, so want to investigate, and hopefully we can share some insights after the call. I'm going to flip back to Nick. Nick, just very briefly, can you remind us? You did touch on the double cabs. Can you just remind everybody what the key dates are, because those are coming up pretty quickly in terms of orders and payments and all of that jazz?
Yeah, so the rules change effective from the 6th of April. So up until that point, if you purchase a double cab pickup, it will qualify as a commercial vehicle. So VAT recovery and capital allowances are optimised. After the 5th of April, the rules change. There are some transition rules. I'll plug our website here. There is a good article about this on our website, and I direct attendees to that if they want any more detail.
Okay, and just sticking with you, Nick, you touched on, obviously, you've got this 10-year repayment of IHT. What's the interest rates on that 10-year repayment plan, please?
Well, that's where the consultation again clarified that the IHT instalments are interest-free, and indeed the consultation extended what could qualify for that interest-free period. So it would be 10 years interest-free.
Okay, and sorry, somebody's just asked, Nick, can you assume that that only apply on the double cabs? This all applies to new double cabs, not new used vehicles. I think we've stumped him.
Yeah, well, the AIA will apply on a new double cab, but you'll get writing down allowance on a used double cab. But again, check the info bite that we've got on our website.
Excellent, plenty of plugs for the Scrutton Bland website here. Just a last one for you, Nick. Valuers, obviously, a key part of everything you talked about is understanding your asset base. What are you experiencing in terms of access and availability to valuers to do that important bit of work? What's the lead time on that, please?
So I've been working across 3 or 4 local firms of Chadstows, which I enjoy very much doing. I think there is I'm not experiencing any undue delays. What's been interesting, though, which is a sort of associated issue, is some of the valuations, particularly with tenancy arrangements, particularly with old style tenancy arrangements, are interesting, as my Farm D, which I didn't get time to fully explain, was about. And the valuer in that instance, who's a very experienced and valuer locally, made the comment that actually the knowledge associated with those valuations is, the generation of land agents who dealt with those is largely retiring, and made the point that actually will the district valuer at the revenue have the knowledge to look at the mechanics of that valuation, which I thought was an interesting point. There's certainly a lot of work about, but at the moment I'm not experiencing delays from the valuers providing information that we need.
Okay. I've got a question in from Rachel. What are the accountant's view on joint ownership deductions on company shares that may lead to held
Got
over
covered
several?
that.
Oh, sorry. Apologies. Yes, you have. Sorry. We rent land under a longer term FBT. Is there value for IHT purposes in the FBT and the long term rented farmhouse? And do you have any ideas of value?
I've no idea. Well, that's a valuer's question. Obviously, the value of the tenant right is a function of the security of the tenure, and that will depend on what act the tenancy is governed. But certainly, the Tenant Farmers Association have been part of the group lobbying with the NFU and CLA. But certainly, valuations of the tenant right is a material consideration to the APR BPR analysis. But that again, that's where that person's advisors need to collaborate so that we can, the valuation of that instance is very key, which is a valuer's conundrum rather than accountant's conundrum.
Thanks, Nick. Will, back to you. In terms of what you're seeing in your client base regarding those clients who are sort of leaning into SFI in a big way, are you starting to see those clients also looking at or considering sort of farm sharing agreements, machinery, labour sharing as a way of managing the residual fixed cost structures of their businesses, or is that not what you're seeing?
I wouldn't necessarily say it's just down to those businesses who are in SFI, Andrew. I think within our industry, the polarity of those at one end who are businessmen first, and their widget and digit is a ton of wheat or a ton of potatoes, will always be at the forefront of all schemes because they've got a full 100% focus on the commerciality of the resources they're working with. The other end of the polarity, of course, is the farmers who farm, because that's what they've always done. And to some extent, one of the challenges for the industry is helping those businesses move up the sliding scale. Now, whether that's going to be from good business advice, having a clear plan in place and a strategy, getting under the skin of their numbers and their objectives, and just helping them on a transitional journey. And in many ways, I think from a farming perspective, things aren't particularly great at the moment. So one analogy you could put on it is that to go through a process with a business to restructure when things are perhaps at a low point should put them in a better place to reap the rewards when things hopefully improve.
Okay, thank you for that,
Andrew. I think probably we should wrap it up. We're over time. Appreciate. There's probably more questions in the chat, but can I please say a very sincere thank you to our panelists for their presentations this morning. I know it's generated a lot of interest, as is evident by the questions. Further advice from all of them will be available, I'm sure. I'd like to thank our partners, Fram Farmers, HSBC, Scrutton Bland, and the Suffolk Agricultural Association. And there's two unsung heroes in the presentation of today. That's Rachel from Scrutton Bland and Izzy, and I'd like to mention them because they've put in a huge amount of work behind the scenes. So thank you for that. A reminder that the session has been recorded and will become available to you all. I wish you all a happy spring day. The weather's good out there, and happy farming. And thank you again for joining us on this briefing.